Good morning. It's a very bullish backdrop for Asian markets this morning. The Indian markets too have been recovering. Yesterday, of course, we consolidated flat close on the Nifty at 22,200, but the mid-caps outperformed with the index up close to about 1%. And for the week, we've seen the Nifty rally close to about 2%. Dipan Mehta, director at Elixir Equities, is now with us on the show. Dipan, one of the stocks on our radar today is going to be Dixon Technology. It's been a favorite, especially in this whole Make in India theme, the rise of India emerging as a mobile export hub, manufacturing in India. And the stock Dixon is up 180% in the last 1 year. But the numbers are very tepid. There is a margin miss. And as the contribution of mobile goes up, the margins have been coming under pressure for Dixon. So how would you approach it?
Good morning, Reema. Thank you for having me on your show. Yeah, definitely the numbers were well below, I think, our expectation at least. And more and more the proportion of mobile telephones low is going to be the margin, but the top line is growing pretty well. And of course, you all know about the valuation. These are companies which traded 100p plus multiples. But the thing is that it keeps getting new contracts, and the PLI benefits still have to accrue to the company. And while the growth momentum is there on the top line basis and the company is executing well, when it comes to all the new signings which they have done with global OEMs, I would like to remain invested. It's a very narrow investment theme, and there are very few choices within that space. And also, I think liquidity on the counter is very tight because of loyalty of shareholders and a lot of institutional investments as well. So I would say that although the stock is expensive on a P multiple basis and this quarter has been slightly disappointing, I would still give some more time and remain invested in the company. I think it's got some more legs.
Okay. Dipan, hi, good morning. I wanted your thoughts on M&M, right? The stock is sitting at a record high, but these SUVs continue to sell like hotcakes. I mean, 50,000 bookings in in 60 minutes is what the new SUV saw. But how much of all of this good news do you think is already in the price? Because to be honest, their tractor business is still struggling quite a bit, given the kind of macro environment. So what do you do now with the stock?
Yeah, good morning. I think the stock has got a lot of room to move up. And I place my positive opinion on the fact that we are expecting a very good monsoon. And of course, tractors business should do significantly better once the monsoon is better. At the same time, a lot of the sales of the SUVs also comes from the rural areas. Not the high end, but the medium and low end SUVs are sold in a lot of rural areas. And at some point of time, I think, if I recollect, 60-70% of revenues are linked to rural economy. So if rural economy is going to do well, I think M&M's next 2-3 quarters also will be exceptionally good. Valuations are reasonable, of course, higher compared to historic multiples. But still, I think the way they are able to generate new and successful new models, and the fact that they have also it's a more cost-conscious company with a lot of focus on return on investment as well. So I think all of these merit a higher P multiple, and there's of course the export potential which they have just about scratched the surface. So keeping the entire view in mind, we're quite positive on the stock, and it could be a real outperformer in the auto space.
Got that. Dipan, hi. Good morning. Just a quick word on Mankind, if you have any thoughts. I mean, it's a local pharma giant, solid numbers, strong distribution, 24%. I mean, big improvement in margins as well. Do you track this one? Any thoughts?
Yeah, good morning, Prashant. It's been on my watch list to buy since it got listed, because I'm very impressed with the business model and the way they have scaled up the company within such a short period of time. And there are a lot of innovation when it comes to marketing of pharmaceutical products, going to tier 2, tier 3, and pricing their branded generics lower than what is available in the market. Definitely numbers since listing have been exceptionally good. But you have a look at the export figure, especially exports to US. That's what's been driving the bottom line, I think. And the investor presentation keeps saying that these are one-off opportunities. And that's what kind of, puts a red flag in my mind that, what if these one-off opportunities were not to repeat in the near future, next 2-3 quarters or so? Then I think, you could have these kind of growth rates may not be sustainable. But nonetheless, I think, it's a great company. And I'm looking for the right price point, a little bit of margin of safety to perhaps make an investment in Mankind. It's a unique company. And I would say a structural growth story, considering that spending on healthcare and branded generic products is only going to rise over the next few years.
And by the way, we reported that Mankind, and this is of course we'll have to confirm that Mankind is looking to buy, looking at the acquisition, Bharat Serum and Vaccines. Now the seller is looking at a 2 billion ticket price. But we'll see, and we'll probably have an opportunity to put those questions to the management as well. Deepan, just one more space, right? The capital goods space, Siemens, if you can have these intradays up, Siemens was up big time, CG Power was up big time, Thermax was up 8-9%, you had Hitachi Energy, which was up about 7%, even industrial gases company, Linde India, KEC, Sterling Wilson Solar. This is the spectrum across capital goods and equipment makers. What do you like here, and what's happening in your opinion?
No, I think that the capex upcycle is well and strong, and from that point of view, these companies are making showing great performance because of bulging order book position. Also, I think the new orders which they're executing just now are at very high operating profit. I would say better operating profit margins. Operating leverages also are coming into play over here, and they are sitting on good order book position, providing them earning visibility. But end of the day, these are cyclical businesses. And if you study their 10, 15, 20-year growth story, then there have been multiple periods where 3-4 years growth goes nowhere, there's negative growth as well. So keeping in mind the cyclicality and that we are in an upcycle kind of a situation, I don't think the present P multiples are kind of justified. I think the likes of ABB, Siemens, Honeywell go at 100 plus P multiple. Even local companies like CG Power and some of the other companies you named, they're also going at 40, 35, 40 P multiple on a trailing 12-month basis. So from that point of view, I just want to be a bit cautious, and maybe at a correction, you could look at buying into these companies if they're correcting by 15-20% and are available at reasonable P multiples, because these are not structural growth stories which can continuously grow at 15-20% for next 5, 10, 15 years, like say a retail company or some of the consumption-oriented businesses. So when one cannot pay such a high P multiple for a business which has got a lot of cyclicality within its operations.
Dipan, in just a bit, we're going to, speak to the management of Colgate. So we'll try and understand a little more about rural demand. But overall, the sense we're getting from most corporates this time is that rural demand has come back. Not in a big way, but there are green shoots. So whether it's HUL, Dabur, Colgate, Hero MotoCorp, all speaking about that. From this entire pack, what would your, pick of the pack be?
See, when you talk about rural growth rates and a good monsoon, kind of a forgotten sector is agrochemicals, And if you have a good monsoon, then towards the end of the monsoon, these agrochemical companies start to do really well. Companies like PI Industries, Dhanuka, Rallies, perhaps even a UPL. So that particular investment theme, I'd like to play through these agrochemical companies. Fertilizer companies also should do exceptionally well. And of course, tractor companies also will benefit. When it comes to FMCG, even in the rural areas, these products have achieved a high degree of maturity. See, back 5-10 years ago, the real play in rural was expansion of distribution networks, and that created great value for all the FMCG companies. But now I think FMCG products have reached almost every village, and further gains from expanding distribution are not visible. Also, base effect has come into play. Rural anyway, a high degree of maturity has come in the FMCG products. So from that point of view, FMCG is unable to generate that kind of a 8-10% even type of volume growth. So I don't find it very attractive. But yes, I think a cyclical upswing in the rural economy could throw up very interesting new investment ideas.
Dipan, what about something like Indus Towers? Yesterday in Bharti's conference call, while they did reiterate the need for tariff hikes, they also said that FY24 was a peak capex year, and capex for Bharti will come down in the subsequent year in FY25, which means that if they spend less, that means more, less business for a company like Indus Towers. So would that be a big negative considering the stock is up 70% year to date?
Indus Towers is an annuity business, and even incremental additions to the towers, keeps on adding to their bottom line. And, the biggest hangover in Indus Towers was the dues which they were supposed to get from Vodafone Idea. And now I think the probability of realizing those dues certainly has improved significantly. And Vodafone Idea itself is going in for expansion and upgradation. So that's an opportunity for Indus Towers as well. And there's a fair degree of consolidation also within the tower space. Valuations are reasonable. business throws out a lot of cash, and management has been distributing it pretty well. And on the whole, I think that it's a good business which can give steady revenues, a kind of a defensive play, if you may ask. And even once the overall health of the telecom industry improves, I think some amount of pricing power also Indus Towers will get, and they may be able to get higher realizations as well. Of course, there's lower power, lower fuel charges also, which may benefit the company. So looking at the overall picture, I'm remaining invested in Indus Towers as a measure of disclosure. We and our clients are invested. And I think that the company can deliver outperforming returns over the next 2-3 quarters or so at least.